How much do you think you can buy this building for? 13 cents. The snag? It comes with $800 million worth of debt.
It's the biggest real estate crisis since 2008.
Offices, shopping centres, hotels and industrial spaces are all losing value fast. One of the biggest challenges in commercial real estate has been the dramatic shift in how we work.
The World Health Organization has declared the coronavirus a global pandemic.
The pandemic has triggered a massive shift to remote work and hybrid working models, and many companies are realising that they don't need as much office space as they did before. In cities around the world, office buildings are sitting empty. In New York, office vacancy rates reached a staggering 22% in 2003, the highest since nearly 1990. Over in San Francisco, vacancy rates have been skyrocketing to nearly 30% as tech companies downsize or shift to permanent remote work. London, one of the largest financial hubs in the world, has also seen vacancy rates rise to over 17%. This means that across the globe, many office buildings are no longer generating the rental income that investors and banks expected. To make the situation even worse, a wave of corporate layoffs and cost-cutting measures have been sweeping their way through most industries. Big companies like Meta, Google, and Amazon have all announced layoffs in the past year and are pulling back on their real estate needs. For example, Amazon recently paused the construction of its second headquarters in Virginia, a project that was expected to inject billions into the local economy. These kinds of moves signal a major shift in demand for office space. So, what does this mean for the broader market? The value of commercial real estate in the US dropped by more than 15% in 2003, according to Green Street Advisors. In Europe, cities like Paris, Frankfurt, and Berlin have also seen significant declines. Investors are pulling back from the sector, and it's creating a downward spiral where property values are falling and landlords are struggling to fill empty offices. It definitely isn't looking good, especially as many financial companies, including pension funds, have exposure to commercial real estate. The construction industry isn't looking great either. Over the last week, ISG, a major global construction company and fit-out firm with over $2.2 billion in revenue, collapsed in the UK. This is potentially a sign of what's to come. And this is where it gets really concerning. Banks and investors are deeply tied to the commercial real estate sector. Much of the financing for these properties comes from loans and bonds, often packaged into products known as commercial mortgage-backed securities, CMBS. In simple terms, these are securities backed by pools of loans on commercial properties, including office buildings, hotels, malls, and industrial warehouses. As these properties lose value and struggle to find tenants, their owners are having trouble paying back their loans. In 2023, the value of CMBS loans in default climbed to nearly $54 billion in the US alone, and this trend isn't confined to the US. The CMBS market is facing similar strains in Europe and other parts of Asia. Banks which have heavily financed these properties are now bracing for significant losses. According to a report by Morgan Stanley, US banks are at risk of losing between $500 billion to $1 trillion on commercial real estate loans by 2025 if the current trend continues. And it's not just smaller regional banks that are at risk of collapsing. Some of the world's biggest financial institutions have exposure to commercial real estate. JP Morgan, Goldman Sachs, and Citigroup all have significant stakes in the sector. As interest rates have risen over recent years, it's harder for businesses to refinance or take out new loans whilst the value of these properties continues to fall, which is a double-edged sword. By the second half of 2023, UK banks had already written off $9 billion in bad commercial property loans, and it's only getting worse. If developers and property owners continue to default on their loans, it could trigger a wave of losses for banks, pension funds, and insurance companies, many of whom have poured billions into the commercial real estate investments. The danger here is that the collapse of commercial real estate could become a systemic risk, much like the subprime mortgage crisis. Back then, it was over-leveraged homeowners who couldn't afford to pay their mortgages. Today, it could be over-leveraged property developers and landlords who can't pay back their loans. As property values decline, we could see a chain reaction where banks, investors, and even consumers are hurt by the fallout. So we have a truly precarious global situation on our hand. Between China real estate bubble and the growing crisis in commercial real estate around the world, we're looking at sectors that have become deeply entangled with global finance. And just like we saw in 2008, when one domino falls, others tend to follow. Now, if you want to know how you can protect and also grow your assets in the next recession, watch this video here. Likewise, this video here is talking about the alarming indicators that we're currently experiencing. Thanks for watching. If you found this video informative, make sure to hit that like button and subscribe to the channel for more insights on the global economy, finances, and the forces shaping our world.